research, you're still trying to figure out whether it's capital adequacy ratios or what are the new tools, loan to value ratios, and so on. So these are the 4 broad areas which have become the focus of regulation. Just now, this is all very, trying to simplify the message. What it also means, these lessons and the way a focus is being brought to consumer protection also means that you decide who to regulate. What are the boundaries of regulation? So for example, would you be regulating a firm which has 20 investors and is not very networked? So for example, some of the hedge funds, unless they are going to cause a systemic problem, is it the job of the regulator to regulate them? What are the costs and benefits in doing so? There are no clear answers, but those are considerations that have to be kept in mind while thinking of who to regulate and how to regulate. Where is the capacity to bear risk? Where is it that we need to be far more aware of trying to protect consumers? So this perspective has led to changes in laws. As we know, the Dodd-Frank, UK, Australia, almost everybody. We've made similar efforts in India where there's a draft law, but many others have gone ahead and already implemented, already passed laws. They have also created new agencies. So for example, the UK now has a financial conduct authority. The US has a Bureau of Consumer Financial Protection, and so on. Going to the next area, which is systemic risk, again, new agencies have been created. The Financial Policy Committee in the UK, the FSOC, or the body in the US, which looks at systemic risk, which pulls in people from various parts of the system. Now, what these changes also require are new databases. So earlier, you had each regulator looking at what the firms he was regulating. And again, that's one of the lessons from the crisis. So for example, from the AIG failure, one lesson was that they just didn't know, the regulators just didn't know what was happening, just didn't know what were the exposures to various firms and how other firms would get affected. I mean, similar issues with Lehman, but the biggest, one of those very, very big problems that did come up was the AIG, which now has made regulators think that one also needs centralized databases, which would allow regulators not only to assess where risks are emerging. So on the one hand, there should be a constant analysis, continuous analysis of that data to assess where risks are emerging, but also in case a financial firm fails, they have the capacity to minimize the damage that it may cause. So the question of systemic risk is tied up not just with putting in place and finding out what are effective macroprudential tools in case you need counter-cyclical policies, but also having the data in hand. And that, again, has required new arrangements, in some places MOUs, in some places proposals to set up new data centers for regulatory data, digitized. And when I come to India, one of the biggest problems would be that most of the regulatory data is not even digitized. So, that's something that needs to be addressed. The US has the Office of Financial Research that is making this effort. In Canada, it is done in the Bank of Canada. And finally, I want to talk about the resolution framework, which it was again a lesson from the crisis, particularly so if you take the example of the Northern Rock crisis in UK. The reason why the British government was not able to step in and resolve it very fast is because the capacity to the legal framework for resolution did not exist. There was not only not an authority to do it, but even the legal framework to just step in and take over assets and resolve that problem did not exist. The second issue in the resolution framework is what about non-banks? So until the crisis, it was banks that were primary. FDIC is the US Deposit Insurance, Federal Deposit Insurance Corporation, that was resolving failure of banks. So failing banks would get resolved. But what about AIG? So what happens when non-banks fail, and how are they to be taken care of? So these are the new challenges that have emerged after the crisis. The impact on taxpayers and the way the bailouts had to happen were also not politically very acceptable to people of those countries, because bailing out large financial firms is not something that politicians are easily able to sell, and that has led to thinking that the impact on taxpayers should be minimized. The legal framework should be such that it should not be that the government has to move in and solve these issues. Now, the biggest challenge in India has been to strike this balance between learning lessons from the crisis, but not going overboard in and over-regulating the financial system. But because in a way, we are at the other end, where the US might have been suffering from too lax a regulatory system, that too many loans were being given, too many structured products, complex financial products were being sold. But we are at a place where there isn't enough financial inclusion, where a large mass of the population, 50% of the population, did not until Jan Dhan have bank accounts, and their participation in the financial system is very, very small. The access to savings or to loans which allow people to smooth their consumption are very small. Even today, people first try to save to buy a house or try to save to study, and they're not able to smooth consumptions over their lifetime. So the challenge here was, yes, there are very important lessons from the crisis. We want to learn those lessons, but we don't want to kill the financial system before we have even allowed it to develop. FSLRC, the Financial Sector Legislative Reform Commission, was set up about 3 years ago by the government, which looked into some of these lessons as well as some of the ground reality in India, and has tried to come up with a framework which is in public domain. Some parts of it are where there is very little disagreement. And the government has been going ahead with some of those. So for example, you do need better consumer protection in India. I mean, a number of studies have been commissioned. A financial redress agency task force has been set up this year after the budget. There will be nobody in this room who would disagree that there's a lot of mis-selling that happens. There are a lot of scams that are happening, and that consumers are getting cheated. So there are some things that one absolutely needs, and there is no disagreement on. The important element here, which is not perhaps that easy and which needs far more public debate, is how the focus of financial regulation in India has to change such that at the heart of it is consumer protection. So you don't just stop activities. You don't just say, I won't let these guys do this and those guys do that, but that you allow it, putting in place both adequate laws and adequate regulations, so not just the primary law, but the regulations, as well as the institutions that try to protect consumers. And that's something that is still work in progress, very much work in progress. And you will see that very often. Just last week, a report came out on, I'm just finishing, on commissions. Some of the other challenges that have been posed and on which there is agreement is that you need digitized regulatory data. I mean, today, some is in CDs, some somewhere. There is no central digitized regulatory data. And so there is a proposal to set up a financial data management center, which would support what there is today within the system, which is a Financial Stability and Development Council. But that needs data that can be analyzed and that can be used. Similarly, there is a need for a resolution corporation, which focuses on both banks and non-banks and is able to minimize the damage to both consumers and to taxpayers. And that there's no question that such a resolution corporation needs to be put in, because only when you have something like a resolution corporation do you have the courage to allow many more financial firms to come up, because otherwise you're always scared that what if something fails? Whereas what you want is, okay, yes, there will be failure. People have to take risks. Finance means that people have to take risks, but we have the capacity to manage that risk. Thank you.
I want to thank, just a minute, Krishna, just two minutes, and then. I just want to thank the first two speakers for covering so many issues. I will not get into anything they have said. That we'll leave for the question and answer and the final remarks. Just want to, the topic is post-crisis financial sector regulation, and I just want to take a step back and give the audience a sense of what happened as a result of the crisis. Assuming that the world GDP is roughly around 70 trillion, people might disagree, but that's the order of magnitude. And I think, again, most people will agree that because of the financial crisis, which some people are now calling the long depression rather than the Great Depression, because it's going on in an unending manner, particularly in Europe, should we say from the base case, GDP growth might have been less by at least 1% for the world as a whole. So I think most observers will agree, although nobody can come up with a precise number. So if it's 1% over 7 years, and again I'm doing simple addition, not compounding, that is 7%. 7% of 70 trillion is roughly $5 trillion. So let's not forget what the financial sector has done to the world. And most of these excesses were done by the private financial sector as a whole. It's not just investment banks, it is also commercial banks. So while I agree with last night's speaker that we need to free the public sector banks, the most important thing there is not the P word, which is privatization, it is the C word, which is competition with appropriate regulation. That's, I think, the goal that India should set itself set for itself. I don't quite know how we'll do it, but that for another day, because it'll be much longer. But again, just a snippet. All of you might have heard of someone called Bernie Madoff or Madoff. Some people call him Madoff because he made off with a lot, although he's paying for it now. I think he has to be in jail for a very long time. But not everybody in this room may be aware that Banco Santander, in terms of asset base, is the largest European bank. It's larger than Deutsche Bank. Why? Because it is also the bank for practically all the Spanish-speaking people, the preferred bank in all of Latin America. That bank gave $4 billion to Mr. Bernie Madoff. Obviously, there is some kickback. So again, I would like to emphasize that just because you're private sector and your boards may or may not have rotten scoundrels on them, there are all kinds of rotten apples, at least, in them, because otherwise you won't have these kinds of decisions. So we in India have to be very careful as to how we proceed, because it's absolutely right that the banking sector, given the fact that capital markets are relatively underdeveloped and insurance and pensions even less so, will have to provide the funding going forward. But how exactly is a matter that we don't quite know exactly, and definitely in this session we can't complete. I'll turn to Dr. Krishnan now to also talk about specifically what he thinks has happened over the last 7 years with particular reference to India. Thank you.
Thank you. Thank you, sir. Good afternoon, friends. Unlike the other panelists, I don't deal with the financial sector in my current work. I deal with issues relating to land in the union government, but I retain an amateur's interest in this topic, and therefore, Rajat, thanks for this opportunity. And I'll take up precisely where you left, sir, the sobering sort of reminder of what the financial system did to the world. And I'd perhaps start with the two sort of basic lessons that I learned in terms of why we regulate the financial sector, a point that Ela alluded to when she started. A standard consumer protection kind of argument. All of us entrust our savings to banks and other financial institutions. At the very least, the society needs to be sure that people taking our money don't run away with it and are instead investing it carefully. Objective A. Objective B, clearly the financial sector is central to modern economies in a manner that is not necessarily true of many other sectors. Given that it is the sector to which we entrust our monies for safekeeping, it handles the system which enables us to make payments, enables us to obtain credit. Clearly, it is akin to the brain of the human body, and therefore, if the financial system cannot perform these functions, the economy will surely be in great difficulty. Oftentimes, it will collapse. So, it is these very broad reasons. There are a number of other reasons which one can sort of list, but these broad reasons why we regulate the financial sector. But I think the critical question that keeps coming up in crisis after crisis is how much should we regulate them and in what ways? And let me sort of make this point, the example very stark by taking just a one-dimensional line in which we have banks, and regulators have the choice of just letting the banks do what they want, in which case surely banks will fail. And the opposite end, they don't allow them to lend at all. There's no risk, and we know the consequence. So even in this one-dimensional line, precisely where the balance has to be struck is not easy. Keeping that in mind, let's turn to what happened in the crisis, the post-2008 situation. Clearly, I think the sense was the regulators had struck the wrong balance. They had allowed banks, and I'm using the word banks to sort of broadly include all financial firms, to take on too much risk. And the consequence was, as others have pointed out, not just for banks, but the home economies where the banks were located, subsequently economies all across the globe. Clearly, there is a sense post-2008 that banks and regulation on banks needed to be tightened. And the key question is how to tighten the regulation that a crisis of this magnitude will never happen again. Now, there were many lessons that could be drawn, but I want to focus on two of them for want of time. A, it was obvious that banks clearly needed to have much more capital so that they could withstand the kind of big shocks we saw and the shocks that led to collapse. B, it is also obvious that banks needed to keep a much larger amount of their proportion of assets in liquid form so that when their customers wanted to withdraw deposits, they could do so without too much difficulty. So putting it in very simple terms, the issue relating to how much capital and the issue relating to liquidity. There are also a bunch of issues relating to too big to fail, the logistical arrangements that deals with resolution that Ela referred to, how to allocate losses across nations when banks are operating in many countries, but I'm going to be keeping away from all of them again for want of time and stick to these two issues of capital and liquidity. Clearly, before the crisis, the so-called Tier 1 capital was approximately the equivalent of about 4% of their risk-weighted assets for banks. I'm making a very generalized statement. And clearly, after the crisis, regulators from all over the world met and agreed on what we now call Basel III, where the capital ratio would gradually need to rise from 8 to 12%, and for systemically important institutions, they would need to hold an additional 2.5 percentage points above the capital for all other banks. And this is being phased in right now, including in India. And my recollection is that it will be fully in place by 2019. Now, will it be right then to say that at least on this particular problem, namely on capital adequacy, that we have reached a satisfactory solution? Do we have the confidence to say that banks now have sufficient capital? I think we need to step back and go into a little bit of sort of analysis on this. Whatever little I have read on this, I haven't been able to find a clear-cut theoretical answer on what constitutes sufficient capital. There are approaches, but clearly there is no agreed framework on this. So let's look at the empirical work. And the work that I found most interesting on this is the working paper that came out of the fund by Retnovsky, where he looks at all the OECD bank crises of the last 50 years, estimates the bank losses in each one of them, and the conclusion that he comes to is a capital ratio of around 18%, 1/8, would have been sufficient in all but 2 or 3 of the extreme crises. So the number he comes to for OECD countries is 18, and given that he was only looking at OECD, and given that for a lot of emerging markets, the rough calculation would be a higher number, clearly for a bulk of us, this number is unlikely to be adequate. This is the first point I want to make, but I think there is a much deeper problem with this norm. This whole business of risk-weighted assets. Clearly, it's a theoretically elegant idea that you keep the amount of capital based on the amount of risks that you're taking. And how did Basel II allow these risks to be calculated, the risk weightage to be calculated? The first method was the regulator would follow the risk classification, and they picked up the risk classification that rating agencies had come up with. AAA rated assets required 0 capital, and AA a little higher, and we know what happened to the world. And the second model was allowing banks to come up with models which the regulators would sort of approve. And again, the empirical answer is that these models did not work during the crisis. They actually proved to be very wrong during the crisis. Now, Basel III tries to sort of address